Good afternoon. My name is Yang Fan Yun and I'm the Governor for MacLeans College. With consideration to the Reserve Bank's policy target agreements, the Reserve Bank of New Zealand has today decided to leave the official cash rate unchanged at 1.75%. As per the new dual mandate for the Reserve Bank, we have considered the inflationary and employment outlook for New Zealand through analysing forecasts for domestic demand, international demand, and supply-side conditions. Subsequently, I'll be presenting our overall analysis of the inflationary and employment outlook and risks.
Domestic demand conditions. Economic growth. Despite GDP growth in the first quarter of 2018 being only 0.5%, recent forecasts by the Reserve Bank show signs of real GDP growth averaging around 3% in 2018 and is predicted to grow at a constant rate of around 2.5 to 3% in the medium term until 2020, keeping up with growth in aggregate supply. With inflationary pressure remaining subdued, any increase or decrease of the OCR will create unnecessary volatility. Therefore, this is a sustainable rate and is a non-inflationary factor. House prices. House prices are still rising, albeit substantially slower than seen in the past few years. House price inflation has slowed since mid-2016, as demand for housing has been dampened by tighter credit conditions, partly due to the tighter LVR requirements and mortgage rates, although these have been relaxed in recent policy amendments. There has been an increased level of activity from buyers as confidence is returning to the market, which slowly pushes up the price. Despite government's promise to build more houses, this is likely a long-term process and is unlikely to increase the housing supply substantially in the medium term. This therefore is a mild inflationary factor. Rent. The trend for average rent growth remains moderate inflationary in the Auckland region. Rents are still rising due to the shortage of houses on the rental market. Vacancy rates continue to be low, but rental yield is holding firm and potentially expected to lift in the next quarter, which is a positive sign for investment market. In the long term, rents may decrease due to subdued demand and increased supply, but is expected to rise in the medium term. This is a moderate inflationary pressure. Household saving rates. After 3 consecutive years of negative household saving rates, current household saving ratio is projected to increase from negative 2.8% in 2018 to close to 0% in 2020. This means that there is a greater marginal propensity to save than marginal propensity to consume, hence leads to a decrease in consumption and aggregate demand, thereby a mild inflationary factor.
Migration. Here we identify a moderate inflationary pressure due to static, if not slowly decreasing levels of migration in the short term. We assume that net migration will fall due to the strengthening Australian labour market, tighter visa requirements, and people with temporary visas departing. With lower population growth, we expect consumption growth and house price inflation to decline. Moreover, given that skilled migrants to New Zealand typically are highly productive, they will contribute more to aggregate supply than aggregate demand. As a consequence, inflation would likely increase in the medium and long term, given Labour's policies to cut net migration, since this will decrease aggregate supply proportionally more than aggregate demand. Government expenditure. Here we identify a strong inflationary pressure. Budget 2018 from the new Labour-led coalition government states that government spending is projected to increase substantially, $2.8 billion every year for the next 4 years. This increases government expenditure, and since this isn't funded by increased income tax, consumption is unlikely to decrease. This means that aggregate demand is increased, resulting in a strong inflationary pressure. Tourism. We can identify that the long-term trend for tourism is increasing. This would result in an increase in exports, potentially leading to an increase in aggregate demand if net exports increase, which will result in a moderate inflationary pressure. Consumer confidence. Here we identify moderate inflationary pressure. We see high and growing consumer confidence due to strong economic prospects, especially compared to other economies. We can observe a long-term trend of confidence, and in recent years, it seems to be stabilized between 120 and 130 index points, which indicates strong optimism in consumer sentiment. Growing consumer confidence will lead to an increase in consumption expenditure and an increase in aggregate demand. Overall, in terms of domestic demand conditions, we have considered a combination of factors influencing inflation, and in summation, we see moderate inflationary pressures in regards to domestic demand conditions.
International demand conditions for dairy prices. Increased production of dairy from other exporters, particularly Europe, has increased the world supply. There has also been a low level of international demand for dairy due to factors like Russia's dairy export ban. The lower demand and excess supply has led to falling global dairy prices. Whole milk powder has fallen by 1%. This decrease in price has caused a reduction in net exports, meaning a reduction in AD. This gives moderate deflationary pressure. Export commodities. All export commodities are performing well, with high and increasing prices, especially lamb, which has risen strongly for the season, with a record forecast 14% increase in average export value. Most sectors are predicted to sustain high prices. New Zealand is a small and secluded export country, which makes us price takers, with highly elastic demand. Therefore, our economy relies heavily on export prices. Increasing export commodity prices will have a large impact on export receipts and AD, meaning a strong inflationary pressure. Exchange rates. Mild inflationary. ANZ forecasts predict depreciation against the US dollar over the next few quarters due to increasing interest rates by the Federal Reserve. This possible decline in the New Zealand dollar suggests future growth of export receipts, as imports become relatively dearer and exports relatively cheaper. This strong economic growth, higher aggregate demand, and thus inflation. In summary, overall, international demand conditions give off moderate inflationary pressure.
Supply-side conditions. In terms of the labour market average wage rates, in the past, wages have had an trend of increasing approximately 1% every year. However, with the introduction of the new government, wage rates are expected to increase due to larger and more frequent hikes in the minimum wage. And this is especially true for low-wage workers, who have the largest multiplier effect and thus greatest proportional effect on aggregate demand. This is therefore mildly inflationary. For productivity, there is a slow rate of labour market productivity increase compared to other developed nations. Since the cause of this is widely said to be structural issues, such as distance from markets, income inequality, and weak capital investment, this means lower growth in aggregate supply and is likely a mildly inflationary pressure in both the medium and the long term. Oil prices are increasing and are likely to continue to increase due to tensions in exporting nations, reducing supply. However, uncertainty remains due to instability in the supply region. This increases cost of production for producers and increases petrol prices for consumers, decreasing aggregate supply and increasing aggregate demand, causing cost push inflation. This is therefore a mild inflationary pressure. For business confidence, we see that current business confidence is decreasing and expected to continue to decrease. Employment intentions eased from 9% to 7%, and a net 28% of businesses expect it to be tougher to get credit, an increase from 26%. This means that businesses are less likely to hire and invest, a moderate deflationary pressure. Overall, all these supply-side conditions suggest mildly inflationary pressures.
Inflationary and employment outlook. Inflation has decreased in the recent past to 1.1% in the first quarter of 2018, mainly due to deflation in food prices, as well as tertiary education due to the government's new first-year fees-free policy. These are one-off and short-term developments and will likely drop out of the inflation calculation in the future. This is still within the 1 to 3% band. Unemployment currently is on a downward trend towards Nauru of between 4 to 5% due to a decrease in net migration. However, forecasts predict that unemployment is likely to stay relatively static at 4 to 5% between now and 2020. This is desirable and it's non-inflationary. Output gap. There appears to be a small and increasing positive output gap. What this means is that aggregate demand is slightly outstripping aggregate supply, with actual output higher than potential output. This is indicative of a mild inflationary pressure in the medium term. Monetary policy decision breakdown. Why have we decided to keep OCR constant? Because even though inflation rate is currently on the lower end of the 1 to 3% target band, there appears to be increasing inflationary pressures across the board. This is especially true in recent developments in rent prices, tourism, and consumer confidence. All these factors are likely to increase inflation rate to a more comfortable part of the band in the medium term at current OCR of 1.75%. This is especially true given the high level of domestic and global uncertainty, including protectionist measures from the Trump administration in the US and political instability in OPEC nations around the world. It is highly recommended to avoid the risks with changing consumer and business confidence and investment uncertainty with changing the OCR. Unemployment currently is also around Nauru of between 4 to 5% and is forecast to remain there. Given the new dual mandate of the Reserve Bank, this should be taken into consideration as a reason for keeping the OCR constant. Key assumptions and risks. Here are the key assumptions we've made in the analysis and forecasting of monetary policy. If these are not realized, inflationary and deflationary pressures may change substantially and financial instability may result. This might result in the need to tighten or ease monetary policy. Thank you.
Great, thank you very much, and very well presented by all of you. So the format of the question and answers will be similar to the last round. So we'll ask you the question, give you a couple of minutes to discuss and answer amongst yourselves, and then if one of you can provide us with a clear and concise summary at the end, that would be perfect. So for the first question, what things would you be looking for over the next 12 months that would make you cut the OCR?
What do you want to
So
start?
first one is aggregate amount, right? Growth to keep that aligned with the PTA agreement of 1 to 3%.
Yeah.
Yeah, it's currently quite low at 1.1%, right?
Yeah. So it's currently at 1.1%. So the purpose of cutting the OCR is to actually stimulate growth, so increase inflation. So since we're currently on the very low end of the 1 to 3% target band, if it lowers any more, that's what we want to look out for if we want to increase.
Yeah, and despite the fact that we are already approaching Nauru, I think, natural unemployment of 4.5%, which is very close to full employment.
Yeah.
And we have the highest ever participation rates.
Yeah.
67.7%. So,
Yeah. So do you guys have some specific events in which that we should be looking out for?
I think perhaps if the exchange rate suddenly, if there's not so many good.
it would also be quite fascinating to see how the Kiwi Build program, when it does come into place, how that would the effect that could have on the policy. And now also talking about our AD, we'd also have to look into consideration the scheduled increases in the minimum wage that could have an increase in consumption expenditure. So I think stimulatory monetary policy is what the Reserve Bank is looking at now. So I think looking at how I would think would have to place particular emphasis on how fiscal policy would play into that.
Maybe with the global trade conditions, if demand for our exports decreases, then we'd want to put expansionary pressure.
Yeah, and also things like oil prices, if they're set to decrease, this decreases import inflation, which also decreases inflation, and that might cause inflation to decrease below 1%, which is unhealthy.
And it also depends on the current exchange rate. If the exchange rate continue to depreciate, then there's no need to cut OCR.
So
if there's
Appreciates
or it remains as it is.
Yeah. Do you guys have any more to add? Okay, so basically what we said is that obviously the purpose to cut the OCR is to create stimulatory monetary policy, so to increase inflation and increase aggregate demand. So we think that what we would want to look out for if we want to if we want to cut the OCR is a decrease in aggregate demand. So things like Kiwi Build, if the Kiwi Build is for example, Kiwi Build, the effects of Kiwi Build are quite big, and it might result in the need to cut OCR to decrease to decrease the inflation, to increase inflation rates rather. If, for example, too many houses, if not enough houses, if too many houses are being built and house prices decrease, that might result in a decrease in inflation. For example, global trade is also really, really important. If, for example, dairy prices or export prices decrease, this might result in a decrease in net exports, which might decrease aggregate demand, and this might also cause a decrease in inflation. Things like oil prices, if oil prices decrease instead of slowly increasing as we predicted, this might also result in the need to cut the OCR in order to bring up inflation again. Exchange rates, we predicted that they will depreciate, but if in the event that they do appreciate, this might cause a decrease in exports and an increase in imports, which might result in a decrease in aggregate demand, which might result in decreased inflation, and that might also this might also require the need to decrease the OCR further.
Great, thank you very much. Next up, Why is it important for the Reserve Bank to consider a wide range of measures of inflation, such as tradables inflation, non-tradables inflation, and core inflation?
So tradable inflation are inflation that could compete directly with imported goods and services, right? And core inflations are the inflation excluding fuel prices and food prices. Thank you.
So that's because you guys have any more to add?
Well, monetary policy has an effect in terms of our international competitiveness. So I think we have to acknowledge that monetary policy doesn't function in a vacuum.
Yeah.
So also New Zealand as an export-based economy, I think that's really important because we have to take that into consideration. But also in terms of the domestic impact of it, things like the CPI and making, effectively the economy does exist for the well-being of people, not just so. So I think both it has practical impacts at home and abroad in terms of our competitiveness.
So there's different effects depending on what products are being examined, and therefore, like for example, tradables inflation might be affected in a vastly different way to non-tradables. And
That's correct. Yeah. Employee also look at welfare as well. Welfare factors. Yeah. So like government benefits and pensions. That could also be considered, right?
you guys have any?
I think it's really important to look at a wide range of factors because, as you said, some things with some factors tradable inflation could be affected a lot more than core inflation. So.
But then in terms of how it relates to the dual mandate.
Oh yeah.
Yeah.
Is that it? George, you have anything? No. Okay. Yeah, so we think that it's really important to consider a wide range of indicative factors for the inflation rate, including tradables, non-tradables, and core inflation, which we because often different types of monetary policies have vastly different effects on all of them, and they all indicate different things. For example, tradables inflation might be much more or much less impacted because of and might also impact, for example, our international competitiveness of our products, which have different flow-on effects to other areas as well. So we think that's an important factor that we have to take into consideration. Core inflation is also really important because it excludes, for example, food and fuel prices, and these are things that are subject to a lot of volatility, and that should be taken into consideration. Because as we've seen in the first quarter of 2018, we saw a huge deflation in food prices, and yet we didn't change monetary policy because we know that food prices and fuel prices are really volatile. Yeah.
Good, okay, just a couple of follow-up questions. Just simply first, talking about different measures of inflation, but which measure of inflation do we actually target? It will be specified in the policy targets agreement.
Measures of inflation do we specifically target?
We want to target core inflation.
So with the PTA, everything in the PTA, right?
Yeah.
Price stability, unemployment.
Is it the CPI inflation?
What's in the PTA?
So we specifically target the inflation rate that's told to us by the Consumer Price Index.
The Consumer Price Index, exactly. Good. Is that a good idea?
Do you guys have any ideas?
Yeah, the Consumer Price Index measures all the prices that households pay. So
It's weighted as well.
Yeah.
That's only on the goods and services, right? And it's not on wage rates.
Yeah.
It's not on. It's not on imported goods.
Yeah. Yeah. And
So imported goods maybe it's fine, and considering the current exchange rates, we might have low imported inflation right now because of the strong inflation. Strong exchange rates.
but what are some disadvantages of using CPI? Because it's quite volatile, right?
And it's very hard to measure.
It's
hard to
difficult
measure.
to weigh things.
Because the census is difficult.
Yeah. And also because
But on the other hand, I think it's important, to balance it out with the dual mandate, because the CPI does reflect the basket of goods that households actually demand, right, that are used across the board. So I think if we're trying to give households the ability to, to plan for these, or workers to negotiate for, etc., I think it is important for us to actually reflect things that actually have practical flow and effect for them.
And it's important to, I think, how
Can I intervene on that? We'll come back to that issue in the very next question. If you could just leave that out of your answer for the moment.
Okay. Yeah. So we think there's a range of pros and cons for using the CPI. We think some of the pros of using the CPI is that it measures the typical basket of goods. There's weightings attached to everything. For example, the fact that people spend more money on food and transport means there's a weighted more in the inflation rate. It also reflects a typical household in New Zealand, and we think that's really targeted. However, some of the negatives of using the CPI is that it's really hard to weight, and it's really arbitrary which goods you attach significance to, and also it's very volatile because about a very high proportion of the CPI is weighted towards food and for example alcohol and tobacco, and also transport, and all these things are really volatile, and it might cause huge swings in the CPI.
And since the CPI is measured the typical consumption of the family, our spending pattern may vary between households. That might be very different from a typical family. Like how would you set a status?
Yeah. So it doesn't take into account the range of different families and the range of different households and the way they spend money.
Okay, good. Thank you. You were about to anticipate the next question, I think, which is relevant. How do you think monetary policy can affect or not affect employment?
So we see the Phillips curve, right? You guys want to add anything?
What does the question?
So how does it affect or not affect employment?
Perhaps stimulatory monetary policy lowers the which will encourage spending, C plus I plus G plus X minus M.
Yeah.
Increase AD. So the Phillips curve is this is wage inflation, right? Wage rate inflation. And then this is the
Do you have anything to contribute?
unemployment.
Wait. Do you have anything to contribute?
So just looking at Phillips curve here.
Yeah.
So say we have a stimulatory OCR that will increase AD, right? Increase consumption, investments, and government spending.
Yeah.
Given the new stimulatory fiscal policy plan that Labour has implemented, and that will increase inflation.
Yeah.
By increasing inflation on the Phillips curve, that would reduce unemployment. And given that we already have a unemployment of 4.5% towards NAIRU, I think that's getting pretty close to full capacity. But given the capacity constraints that we currently have, for example, like the factors of production, the shortage of land, skills, and looking at the construction industry, right?
Do you guys have anything?
Yeah, I mean, but it's still important to consider the the theory of the Phillips curve. It's still this the theory's a little bit weakened recently.
Yeah.
But
Yeah, that's true.
Yeah, I think the Phillips curves weakened recently due to structural changes in the labour market.
Yeah.
So maybe a lower natural rate of unemployment is possible now.
So is that it? Okay, so what we think is that the Phillips curve states that when you decrease the OCR, have stimulatory monetary policy, you increase aggregate demand, so you move your economy closer to full employment, and therefore you decrease employment while also increasing inflation. And the opposite is true when you decrease the OCR, when you increase the OCR rather. But we think that the Phillips curve has become less relevant and less significant in the present because of structural changes to the economy. We see that in the American economy, the Phillips curve is becoming much less relevant in the present. So we see, for example, issues such as international competitiveness, which means that employers can't just increase or decrease the wages based on inflation rates because there's other economies in the world to compete against. There's also less skepticism and less of and because of the Reserve Banks is generally quite good at controlling inflation, and therefore people don't really and employers and investors don't really have inflation at the front of their agenda, which means that they don't really take it into consideration as much as before. So we think that employment is to a certain extent affected by the OCR, but we don't think it is especially in recent times.
And if you want to look at unemployment, it will actually be the supply side policy that will reduce the unemployment in general, because that will shift the long-run Phillips curve to the left, which will decrease the whole NAIRU from 5% to a lower percentage. That will also, without exerting any inflationary pressure, but reducing unemployment. And hence achieving the dual mandate of the Reserve Bank.
Thank you.
Great. We've got time for one more question. So, how might government policies affect the Reserve Bank's objectives?
So I think one of the obvious candidate here is we're starting with the new dual mandate. So the Reserve Bank is now tasked with having to support sustainable employment. So I think also given that the government is now pursuing a more expansionary fiscal policy, I think in terms of the inflation rate targeting regime will have to be a little more, what would you say?
Yeah. So now, some government policies may require the Reserve Bank to change their policies often. For example,
Especially given the increase in transfer payments and more income into an increase in government expenditure.
Yeah, government. So like if the government decides to like increase their expenditure, that would affect the aggregate demand to shift to the right. So like the Reserve Bank would have to increase the consider that when changing the OCR.
Could policies like free tertiary education give that help with lowering unemployment?
Potentially in the long term, so the government definitely has effects.
And so talking about the government and fiscal spendings, right? Government policies and stuff. So if Ricardian equivalents hold, even though the government has a simulatory fiscal plan, we will unlikely to see an increase in consumer spendings, and hence aggregate demand increase will also be unlikely or insignificant. So that might cause an stagnant effect on the inflation. That is only if the Ricardian equivalents hold.
Do we have any other ideas? So we think government policies have a range of effects on the Reserve Bank's objectives. For example, the different range of government's policies. For example, the new Labour government's plan to spend more money. For example, by and also increasing the minimum wage, providing free tertiary education. We think all of these policies have a huge effect on aggregate demand and also on aggregate supply in the long term. And we think the Reserve Bank has to take these into consideration when they observe the changes in to predict and forecast changes in inflation and also unemployment. And we also think that, for example, government policies about the Reserve Bank, for example, the dual mandate that was recently initiated for the Reserve Bank, we think this also changes the outlook the Reserve Bank has to take in order to craft monetary policies.
That's very good. So I heard an interesting word, Ricardian equivalence. Do you want to explain to me what that is?
I can't explain it. So Ricardian equivalence basically states that consumers generally know about how the government's going to create policies. For example, if the government taxes more money now, they're more likely to save less now because the government probably is likely to decrease taxes in the future to make up for this increase in tax now. And so people generally don't change, and so changes in aggregate demand typically aren't as effective as the government might hope for it to be.
And it's mainly on consumption.
Okay, you can relax. Questions are over. Enjoy the rest of the day and we'll see you this afternoon.